A very good day, ladies and gentlemen, wherever you are in the world, and welcome to ITR's web seminar on today's India budget, taking place in association with Dhruva Advisors and Taxsutra. I'm Anjana Haynes, Managing Editor of ITR, and I'll be hosting today's event alongside Arun Giri, Co-founder and Group Editor of Taxsutra. For corporate taxpayers, perhaps the big news from today's budget included the abolishment of the dividend distribution tax, the introduction of a taxpayer's charter, allowing faceless appeals, and measures to help certain specific sectors. But there was a lot more tax and economic news, as we'll hear about soon. Before we go any further, there are some items I need to mention. First, we will be concluding this web seminar with a Q&A session, which you can participate in by asking questions at any time during the presentation. Just type your question into the Ask a Question text area below the presentation window and click the Send Question button. Our panelists will answer as many questions as they can at the end of the seminar. If there are any specific matters that you wish to speak to the presenters about, please contact them directly after the webcast. Second, the recording of this seminar will be available on the ITR website at www.internationaltaxreview.com. By logging on there, you'll be able to see the presentation again and hear this discussion. You will also be able to forward this to any of your friends or colleagues that you think might be interested. Thirdly, there are occasional technical difficulties with the sound and slides coming together. If you encounter any of these problems, please refresh your window and this should correct it. So we have some distinguished guests with us today. We have Dhruva Advisors, which is led by CEO Dinesh Kanibar. He will be joined by Umesh Gala and Ranjit Matani from Dhruva as well. And we also have the very special privilege of being joined by Akhilesh Ranjan today. Thanks to all of them for taking part. As I mentioned, you are free to contact them at the end of the seminar or ask any questions you wish, and we will try and answer as many as we can towards the end. So, without further delay, I would like to pass this over to Arun and Dinesh to begin today's seminar. Over to you, Arun.
Good evening, and just in case my voice does not sound as energetic as it usually is on a budget, well, a lot of people have lost a lot of money on the stock market, so I'm not one of them. I'm not a big punter on the stock markets. But if the budget last July was all about the big ideas, the big ticket vision, a $5 trillion economy, well, this budget, the first full budget of Modi government 2.0 in its second term, was anything but big. A lot of people were expecting the budget to boost the economy, to give that big booster shot to the economy, which has been struggling for the last several quarters, with the GDP growth coming in at not so great pace over the last few months. A lot of people thought there would be provisions, announcements that would spur job creation. Everyone knew that the fiscal math was tough. The finance minister, having already announced a massive corporate tax rate cut just a few months ago, did not have the fiscal space to do much. Yet, there were expectations galore. And I can only say, when I was live on a news channel and we were 1 hour past the speech, everyone was stunned. And the whispers were loud that this is not the budget we were expecting. 1 hour into it, the next 90 minutes was quite honestly was nothing much to talk home about in terms of the big announcements. On the tax front, of course, you can't fault the finance minister for giving us a lot of things to chew on. I'm sure we are all going to spend a long night ahead of us. I'm so thankful that Dinesh Bhai took my advice. I usually do not do that ever. But when Dinesh Bhai wanted to advance the timing of this webinar to 4 p.m., I just requested him that let's keep it at 5. 100 amendments to the finance bill on the direct tax side, a few more I think on the indirect tax side. We'll decode them along with who else, one of the leading voices in the world of international tax, eminent international tax expert, Mr. Akhilesh Ranjan, former CBDT member who's led India's charge on BEPS, who led the DTC task force, and a big provision of the DTC task force recommendations finds its way into the budget. That is the change to the residence rules, bringing stateless persons or stateless NRIs into the tax net. But if there are 7 or 8 provisions, which I'm sure Dinesh Bhai will now touch on: personal tax overhaul, DDT abolition, residence rules, deferral of SEP provisions, Section 90 amendment in line with MLI, TDS on e-commerce transactions, TCS on overseas remittances which are made under the LRS route, amendments galore. There may be several dozen more smaller ones. Each of them would need to be gone through in some detail to decode it. I'm sure Umesh Bhai and team will do that over the next 90 minutes. But for the big picture, if Dinesh Bhai feels that this is a big picture budget, I would like to hear from him. Privileged to be joined by one of the leading international tax experts. Dinesh Bhai, over to you.
Thank you, Arun, and thank you all for joining in on a webinar on a Saturday evening. I do remember when I was talking to ITR and their first reaction was, Saturday, and you would like us to host a webinar? Indian government and Indian budget is what it is, and here we are on a Saturday, instead of talking about things of leisure, talking about taxes. We heard what was the longest ever speech by a finance minister presenting the union budget. Her last speech was the longest ever. It beat the earlier one by a couple of minutes, and this one beat the last one by about 15 odd minutes. So a very long speech, and broken up into 2 parts as it always is. One were the announcements on the economy, where is the government going to spend the monies, and clearly the thrust is on agri, the thrust was on infrastructure, a lot of policy announcement and lot of post-policy dissection of those announcements. So when the government announced a huge amount of investment into education, the first question was, what was it spent last year, and is this really an increased spending or not? But let's come to what we would like to discuss today, and which is why all of you have taken the trouble to dial in today, which is to look at the part B of the finance bill and many of the changes that have been brought about to the direct and the indirect tax laws. And Arun rightly articulated several changes impacting virtually every taxpayer. So whether you talk about the changes in the rate of taxes for individuals and giving them 2 regimes of taxation to make a choice from, a la what was done a couple of months back for companies who were given 2 regimes and they could choose one of them, either play a flat rate of tax availing no deductions and concessions, or pay a higher rate of tax but take advantage of taxes and concessions. A similar sort of a regime being proposed for individuals. Not going to be an easy take, because we're talking about the going away of standard deduction, leave, travel allowance and the like, something which has been part of history for most individuals, employees, more important, not getting interest for monies borrowed for housing, etc., etc. So again, virtually impacting every individual. A reduction in the rate of taxes up to income of rupees 15 lakhs, again something which is going to impact most people. More important, as Arun alluded, total change in the regime of who are the people who can be regarded as residents of India. And a change, if I may say so, a la USA, where if you are a citizen of India, you would be regarded as a resident of India, provided, of course, you are not paying taxes elsewhere. And what is the ambit of that provision? What are the controversies? Umesh will take us through. And then we have the dividend distribution tax. This was one change which was widely expected, anticipated. But now that it has come about, it is throwing up its own interesting facets, challenges. Do we need to review the entire way in which corporates are held by promoters? You will be all aware, for example, that over the last couple of years, in anticipation of inheritance tax, most people had moved that shareholding into a trust structure. And now in the new regime, probably that's the most disadvantageous way of holding shares and getting dividends. Are we going to relook at it? Interesting set of things to chew on. And then, of course, finally, the dispute settlement scheme. To go back and say, if in the next 60 days you're going to pay the taxes, then you can look at a waiver of interest and penalty. Very, very interesting. There are times when you're advising clients and you come back and say that there's a dispute going on for the last 12, 15 years, which is very normal, usual period before an item can get resolved at the tax office. And in the meantime, you have run up an interest meter, which is far, far, far in excess of the principal liability to tax. And you might just go back and say, look, there are new judgments coming, interpretations are changing, the basis on which I took a particular position no longer holds good, I might as well pay the tax and move on with life. The foreign tax credit regime has changed thanks to changes in US tax laws for foreign companies, and they might want to come back and say, well, if I can pay tax and get a credit to overseas, why not simply move on with life? So very interesting to see how these provisions span out and what sort of a response government gets. Clearly, the government is looking at revenue mobilization, and that is why this very short window of trying to gather as much funds as one can before 31st March. And while we are looking at these important breathtaking changes, are several other changes. The incorporation of MLI, for example, into the domestic tax law, the provision related to tax collection at source, the ability to get advance ruling in the case of permanent establishment, see changes, number of changes. And whilst Arun did mention that to decode the budget, one would have to go through each one of them, I do not think that this webinar will be giving sufficient time to go through each one of it. Umesh on the direct tax side and Ranjit on the indirect tax side will take us to some of the more important and the key provisions. But hopefully that will whet your appetite, and as we move on, new facets will get discovered. Before I hand over to Umesh to carry out an analysis, can I request Mr. Akhilesh Ranjan, if you just want to give some introductory comments, thoughts, remarks on what you saw today as presented by the Finance Minister.
Thank you, Dinesh, and thanks, Arun, for all the good words. Yes, it was a very long speech, but I think she was very, very eager to touch upon all the relevant aspects, and I think she did manage to touch upon all those relevant areas which are of concern to the government. So a great deal of thought apparently has gone into the budget, and we must commend the FM for the great effort that she has put in out there. Now, of course, how much expenditure is in excess of last year, all those comparative figures are something that we'll have to see, but that's for later. Right now, I'm sure people are all more interested in Part B or the direct tax proposals. And there I would say that as the convener or head of the task force, which had submitted a report to the government in August last, I'm satisfied. I'm happy that some of the proposals have been incorporated in this budget. We had suggested a rejig in the personal income tax rate structure. That, of course, has been done, but with conditions attached. It's to be discussed and seen how far these conditions are will prevent or dissuade people from opting for the new structure. The change on the dividend distribution tax, and that's something that we were very strong on in the task force report, and I think it's a very logical step after the reduction in corporate tax rates. I would have, of course, wished that the corporate tax reform could have been carried forward because we haven't yet touched the tax on foreign companies or a branch profit tax or a minimum alternate tax on all those issues are still there. But anyway, this is a major step. It is something which will be hugely beneficial, I'm sure, to the Indian economy. And there are, of of course, estimates about how much of revenue loss there's going to be, but I think the way it will pan out, perhaps the figure that has been cited by the Finance Minister may be the amount of revenue loss that goes. But it's a very, very good step in that. And then there are, as Dinesh mentioned, I think he's extremely interested in this topic of taxing the non-resident or the Indian citizen who is not a resident of India. That's again something which we had mentioned in our task force report, essentially to curb a tendency on the part of certain people, certain Indians that we have been noticing over the years and which has been increasing. Yes, of course, there will be areas which for discussion out there, but I think that's what we have to take them up. But the idea, I think, is something which was called for, and mere complicity should not stop us from doing these reforms in the tax system. There are other changes, even smaller ones, like the citizen charter that the SM has been mentioned. We in a task force had talked about accountability, and this is another form of accountability. I think this is what every taxpayer or every citizen has been talking about. There has to be some element of accountability on the tax department. Well, this bringing the charter as a part of the law, or statutory law, is in fact giving that bringing that element of accountability, and it should be viewed from that perspective. The notification is yet to come, but I hope it will be drafted properly. It will be drafted in a manner which is beneficial and it actually serves the purpose. There are several other things like the registration process for charitable organizations is another recommendation that we had made in our task force report. I'm happy that has been incorporated. There are too many complications and disputes and litigations involved in registration of trust. I think the government in that is living up to its promise of letting people do their business or their work or their charity and step in only when there is an irregularity noticed. So a number of things, there are some others also, in fact, which have been mentioned in the task force, and I'm yet to go through the entire finance bill. So all in all, I am satisfied and happy that the process has started of changing the tax system or the code that we have. A number of significant steps have been taken in the corporate income tax and in personal income tax now. There are many other elements of the task force report and things that are required which need to be done, and I hope that the government will take up those matters at the earliest. The litigation, the scheme for resolving disputes, I don't know how it's not on the same lines that we have recommended in our report. It is yet to be seen how successful or effective this is going to be. But yes, more needs to be done on controlling and managing litigation. So there are, of course, many areas, and I hope, as I said, this process is started, it is on, and given the indication that the government has given, I'm sure this process will be taken forward.
Yeah.
So I am satisfied. I know that there are expectations, and many people may not be very happy with how things have panned out. But I would look at it in a positive way and say that the process of reform of the tax structure has begun. So that's my take on the thing.
Yeah. So thanks so much, Arun. And one question to both you and Dinesh bhai is, considering the fiscal math, already so much of such a big corporate tax rate cut was announced. Was there really a headroom to do something more ambitious on the tax front, sir? To you and Dinesh bhai both. And second question, while Umesh bhai will take us to the fine print, the residence rule surely is okay. Dinesh bhai says that we'll take that later. But Dinesh bhai and Akhilesh sir, this question on the fiscal math, do you really think the FM had the headroom to do something more ambitious?
No, so I think, I'll take this first. That seems to be the major issue which is holding the FM back on a more comprehensive rejig of the personal income tax structure. You will notice the number of slabs that have been brought in now. I think clearly the attempt is to minimize the revenue outgo. Of course, it does create more complexity in a way, even though the FM wanted to make it a more simple regime. But when you have 4 or 5 or 6 different slabs, then apart from the problem of bracket creep, which there is a tendency of people to change or to shift into brackets. Apart from that, it does create complications. It does need more calculators to compute your tax liability. So the headroom, of course, was not there, certainly very clearly not there, and that, I'm sure, has been the major reason for not going full steam with a more comprehensive reform. I think in the circumstances, I'm not very sure whether that 45,000 crore will actually turn out to be that way, because we don't really know how many people will opt for this new scheme. But then I think clearly the attempt has been to curtail the revenue outgo.
The only quick comment I'll make, Arun, is that I don't want to stand between the deeper analysis and the audience. I'm finding the tax rate regime to be the most complex one has ever seen. So you have one regime which if as an individual you do not opt for concession, another tax rate regime. If you opt for, similarly for corporates, one regime and yet another regime, and then a third regime if you are manufacturing, and then you have multiple slabs for capital gains tax and holding period from different class of assets and different rates. So in that sense, I may dare say that while the finance minister began in her speech to say that she wants to make the tax law simple enough not to need an advisor, but I think this is even more complicated than what it ever was. But with that, let me hand over to Umesh for analysis of the direct tax provisions. Over to you, Umesh.
Thank you, Arun, Dinesh and Akhilesh for creating a general background about the much anticipated budget. And we will now go through the relevant provisions of the finance bill, with me taking up the direct tax provisions. And we will, given what Arun has said, that 100 plus amendments, we will try and focus the discussion on some of the relevant provisions. One of the biggest introduction is an alternative tax regime for individuals, and as has already been briefly highlighted, that individuals a la corporates also now have a choice to opt for a different regime. And I will not actually take you through the rates, because those rates have been specified by the finance minister in the budget speech. But basically now individuals have a choice to opt for a regime where they get a concessional rate of tax with some slabs, which the 30% tax rate kicks in after 15%. So between 5 lakhs and 15 lakhs, there are some lower slabs that give a benefit in the overall tax liability for an individual. But this comes with some riders and conditions. And the riders and conditions are that the individual has to forego basically all exemptions and deductions, starting from standard deduction, the house property interest deduction or the benefit of loss, any or other exemptions which the individual is entitled to. Let me clarify that this is an optional scheme, and the contours of the optional scheme are such that an individual who is not deriving any business income will have a choice to decide whether he goes with the existing regime or the new optional regime on a year-to-year basis. However, a person who is an individual or an HUF who are deriving income from business, for them, except for a one-time change, once they have opted for the new regime, then they will not be able to make any fallback on the old regime. If you go to slide 4, we've already covered no exemptions or deductions. The framework for an individual who is carrying on any business is more or less similar to what was introduced for corporates, namely that they will not get benefit of any carried forward losses or depreciation which is attributable to specified deductions which the individual or the HUF is now not entitled to claim. Depreciation will continue, and if there is any loss of depreciation on account of the choice which the individual takes, then the unabsorbed depreciation will be added to the written down value. They will also be entitled to claim benefit of unit in a IFSC. We've already covered the switch on, switch off, and no AMT is applicable. So basically net for individuals and HUFs, it will boil down to a math on a yearly basis. You will have to decide whether the tax liability is lower under the old regime or under the optional regime. And obviously if you are able to figure out whatever your overall tax liability is, either by yourself or through an accountant or an advisor, you will need to figure that out and then take a decision whether you opt for the new regime. This was a change that was expected because there were expectations that the government will throw back more money in the hands of the taxpayers. The overall tax giveaway seems to be in the region of 40,000 crores. But again, as has been highlighted by some of the earlier speakers here, this will ultimately boil down to individual choices being made, and I'm sure government has some math when they have estimated this 40,000 crore giveaway. The next major change is with regard to the tax residency conditions, and again I will take you through the fine print. One of the significant changes that have now been introduced is that a citizen of India, he will be considered to be a resident of India in a situation where he is, if he is not, if he is staying in a country outside of India and he is not liable for tax in that country either on account of residence, domicile or any other criteria of a similar nature, then such individuals will be treated as tax residents of India for Indian tax purposes. So this would basically impact, including in some cases citizens of India who are staying in UAE and similar other jurisdictions. The next change which has been introduced is with regard to two changes on the residency. The first one is a little technical, but I will very quickly deal with it. As far as the residential criteria for individuals, there are two criteria, 182 days and then 4 years, 365 days subject to a minimum of 60 days. Now that minimum of 60 days was relaxed to 182 days in an event where a person having been a non-resident came on a visit to India. So that visit to India, if it was a temporary visit, you got the benefit of 60 days being relaxed to 182 days, which has now been curtailed to 120 days. The other change is in India there are three residential statuses. One is a resident, the other is a non-resident, and there is a middle category of a not ordinarily resident. And all of us we know that the way the provisions with regard to the NOR were drafted, they were quite complex, and this is a beneficial change which has been introduced, whereby so long as you are a non-resident in any of the 7 out of the 10 preceding years, you will get the benefit of the NOR status. And this relaxation applies both to individuals as also the HUF, where in the case of HUF the test will be considered or applied to the manager. Akhilesh, if you want to...
No, I think you should continue and complete your presentation. We can take it up later.
Okay. Yes. We now move on to the withdrawal of the DDT regime, which is again one of the most anticipated provisions, and if you actually take a vote, maybe 8 out of 10 or 9 out of 10 felt that this is a change which is likely to come because the FM had made certain statements in the parliament. This is a major change which will impact, as Dinesh had very clearly highlighted, a lot of the promoters of listed companies and the other shareholders. We'll quickly deal with this. So current regime was that dividend distribution tax on dividends declared by any corporate was liable to be paid by the company with a corresponding exemption in the hands of the receiving shareholder, except that a change which was introduced a couple of years back, individuals and other categories, if they had dividends in excess of 10 lakhs, they were also liable for a 10% tax in addition to the DDT which was payable by the company. So now the DDT of the gross rate of 20.56 is now abolished. So you have a new regime, in which is a throwback to the earlier regime where dividends were taxable in the hands of the recipients. So no DDT to be paid by companies. This provision kicks in for all dividends which are likely to be declared from 1st April 2020. One of the changes which is parallelly introduced is that so dividends will now be taxable in the hands of the recipients. When the recipient offer the dividend for their individual taxation, they will not get benefit of any deduction of expenses except for interest, and the interest which is incurred for investing in the shares, that the deduction on account of interest is capped at the rate of 20%. So this basically is an indirect 14A which has been introduced as far as dividend taxation is concerned. A noteworthy feature of this regime is that, and the FM did refer to in her speech as well, that one of the angst which many of the non-resident investors had was the DDT which was being paid by corporates. There were a lot of questions on whether that DDT would be creditable in the hands of the recipient non-resident shareholders. So now with dividends being taxable in the hands of the recipients, this sort of evens out the uncertainty in the hands of non-resident shareholders. So all non-resident shareholders who are coming in through treaty countries, they will get the benefit of a lower rate wherever the treaty does provide. So this will be a welcome change in the hands of the non-resident shareholders. And since this is a throwback to the old regime, we had section 80M where if a corporate shareholder, if they received any dividend, then to the extent of any dividend further paid by them, the cascading effect has been nullified. So long as the corporate shareholder makes the payment of dividend 1 month prior to the due date of filing of his return of income, then the dividend so paid will not be liable to tax in the hands of the corporate, and therefore all holding companies which receive dividends from listed companies or from any other similar companies, they will have the benefit of a rollover with no cascading impact. A corresponding provision which has now been introduced is that there is a 10% withholding tax on the dividends, which is applicable to residents. The new regime on taxation of dividend has also been parallelly introduced for dividends declared by mutual funds. So dividends received both from corporates and mutual funds will now be subject to the same regime of the dividends being taxable in the hands of the shareholders or the unit holders. There is a fine print which so all non-residents who had invested in infrastructure debt funds, currently the existing provisions of 115R gave a concessional rate of 5% tax for such investments. Since section 115R has now been deleted, therefore the benefit of 5% tax for dividends on infrastructure debt funds goes away, and therefore these dividends will also now be taxable at 20% under 115A. What is noteworthy to keep in mind, and there is no provision, but buyback tax which was actually introduced for listed companies because many companies were resorting to buyback to avoid the dividend distribution tax payable for corporates. Therefore a buyback tax was introduced. No change has been made to the buyback tax regime. coming now to the international tax regime. So one of the significant changes that India had introduced a couple of years back, and this was in line with the OECD BEPS project, and therefore significant economic presence was a test which India introduced in Section 9. And this, as I said, was in line with the OECD BEPS regime which was being considered. What changes that we are seeing right now, and I'll quickly deal with some other changes. One is that the SEP, the Significant Economic Presence Test, for taxation of incomes of digital and social media players, insofar as they are generating revenues out of customers who are participating in the social media or on the digital platform. The test has now been made applicable from, so it has been extended, and therefore it will be applicable from the financial year 21-22, relevant for assessment year 22-23. And Akhilesh, if you would want to give some comments on this.
No, I think this is one reason for this. I mean, there's no substantial change made in the concept of that significant economic presence. There is an elaboration of what the income attributable will include. That's important. That's a new thing. But otherwise, the change is just essentially to clear the language of the earlier provision, and in recognition of the fact that we had brought in this provision in, I think, 2017, and we did not bring out the rules prescribing thresholds precisely because the matter was under discussion and still is under discussion in international fora. So, but then one can't keep a provision on the statute for long. So I think it was replaced by another one, keeping intact the meaning of significant economic presence, but elaborating on what sort of income will also be ascribed to it, and that's important thing that would probably need some discussion as to in what circumstances and how the income will be computed.
Yeah, thanks Akhilesh. And so coming to the change in terms of how the income will be computed, the current provisions in Section 9, insofar as it deals with income from a business connection in India, they provide for taxation in respect of income attributable to the operations in India. Now, obviously, in the case of the digital and all the social media platforms which are being used so prolifically by Indian residents, the test has now been clarified in Section 9 to say that the scope of income attributable to Indian operations will include broadly three categories. One is income from advertisements which are targeted for Indian resident customers. Second is sale of data collected from Indian residents. And the third is sale of goods and services using data collected from Indian residents. So irrespective of whether the social media or the digital media companies, whether they are earning income directly from India, so long as there is an attribution of income which will be connected with the users, with the customers who are sitting in India, and as long as they participate on the social media platform, government will come out with some rules to provide for the relevant taxation for such categories of income. Some of the other changes, and we move to slide 9. Some of the other changes on international tax, and I will very quickly deal with it. The first change is that as far as FPI is concerned, the foreign portfolio investors are concerned, SEBI, there were currently three categories of FPIs, category 1, 2 and 3. Recently SEBI merged category 2 and 3, and one of the changes which is now brought in is to take or to give impact to the change which has now been done by SEBI. And this deals with the indirect transfer. So there was earlier an exemption for levy of tax with regard to indirect transfers of some category of FPIs, which was category 1 and 2. But because now category 2 and 3 has been merged, and therefore the exemption with regard to indirect transfer will sustain only for category 1 fund, with category 2 fund being liable for tax on account of any indirect transfer. The other change, and I will be a little quick on this, for attracting foreign fund managers to set up their offices in India or to set up their activities in India, the government had come out with a regime, but as we often see the fine print on the conditions attached to that, so there were a laundry list of 17 conditions subject to which those foreign fund managers who had set up their offices in India, they would not be regarded as having any economic presence in India so as to attract any tax liability. In those 17 conditions, 2 of the conditions have been relaxed. So the minimum corpus of 100 crores, again there were different deadlines, and now the government has modified the deadline to say that the 100 crores is to be achieved within a period of 12 months from the date of incorporation or establishment of the fund. Again, another relaxation which was there, that if there is a foreign fund in which resident individuals are participating, the resident individuals could invest up to 5% of the foreign fund. Government has in the finance bill proposed an amendment that if the fund manager invests, then even that will be considered to be an exclusion, subject again to a further condition that the fund manager's investment does not exceed 25 crores, and again there is a window, limited window of 3 years, and therefore they have to unwind the investment which they have made within a period of 3 years. Again, if we look at all in all, these are conditions upon conditions, and therefore people will find it very difficult to deal with all those conditions, but subject to dealing with all the conditions, then they can get the benefit of no tax on the fund manager's operations in India. Moving further, and this is in line with the changes that are also introduced for significant economic presence. So both for any permanent establishment or on account of business connections, if there is some tax which is attributable to the activities in India, then there is a safe harbor rule which government of course will specify the rates, and such entities will be entitled to avail the benefit of the safe harbor rules. Another amendment which is there and which is in a way a significant amendment, and maybe we will, after I briefly deal with it, we'll get comments of Akhilesh on this, is amendments in section 90 and 90A, where the government has brought in the preamble to the MLI, and the preamble to the MLI has now been incorporated in section 90, and therefore, if there is a double tax avoidance agreement, and if somebody is availing of the double tax avoidance agreement for creating opportunities for non-taxation, or what is popularly regarded as treaty shopping, then that will invite difficulties. And Akhilesh, if you could quickly highlight what is the background of this amendment and how it will impact people availing double tax avoidance agreements.
No, I think the purpose is to ensure that the provisions of the MLI which get incorporated in our treaties stand and are not questioned only because there is no corresponding provision in the domestic law. It's as you have seen in many other cases also, wherever there are changes made to international treaties, we have tried to bring those same things also into the domestic law, because as you're aware, the charging to tax or the main provisions is the domestic law. An argument can always be raised that the treaty is only, if the treaty by itself doesn't give the authority to invoke an anti-avoidance measure unless the domestic law allows it. So I think that's the only logic out there. And so that I personally don't think that this has too much of significance.
So Akhilesh, there were some views that a country like Mauritius, which has not notified India for the purpose of MLI, and therefore people were hoping that as far as Mauritius is concerned, the MLI will not come into force because Mauritius has not notified. Now, by virtue of this amendment, do you feel persons who are participating through Mauritius would also get impacted?
No, I don't think so. You see, that's a misconception. Right, Mauritius may not have included India as a covered treaty partner in the MLI, but at the same time, there is a commitment on their part that they will introduce similar provisions in the bilateral India-Mauritius treaty. And in fact, we are awaiting their response to our request for negotiating those clauses. So, because it's a minimum standard, this introduction or bringing this preamble into the tax treaties is part of a minimum standard agreed to by all countries, even including Mauritius. So, it has to come into the India-Mauritius treaty. Only thing, for some reason, Mauritius didn't want to do it through the MLI. They said they will do it through bilaterally with India.
So this would also
it's not much. I think 90A in any case deals with where we don't have a treaty at all.
Yeah.
So it doesn't relate to covered or uncovered tax agreements under the MLI. So I think there's issue out there.
So Arunya, just a clarification, and this will be very basic, but the fundamental provision of section 90, I believe, which says that taxpayer can opt for either the domestic legislation, that is the Income Tax Act, or the DTA, whichever is more beneficial. That remains completely untouched by any of these amendments, right, sir?
Yes, at the moment it is untouched, yes.
Yeah.
Of course, I mean, what it really says is that the domestic law shall prevail to the extent it is more beneficial.
Yeah.
Which again clarifies that all the charging, the taxation, everything is by the domestic law, which will get overridden by the treaty unless the domestic law is more beneficial.
Yeah.
So that position remains. That position remains absolutely. By including this wording of the preamble in the objectives of a tax treaty, I mean, I think it's just making it very clear that tax treaties are also, I mean, the domestic law, Section 90 is the authority for the government to enter into tax treaties. And if we are entering into a certain language in the tax treaty brought in by the MLI, then the domestic law should also provide that authority.
Yeah, thank you, sir.
Thank you, Akhilesh, and I think we will take this forward. The other amendment on slide 10 is with regard to relaxation, and this is again a welcome amendment where if a non-resident is earning any royalty or fees from technical services as also dividend income, and if an appropriate withholding tax has been deducted, then such non-residents are not required to file any return. Moving further, we now go to slide 11, which introduces a new regime for tax withholding on e-commerce transactions. So this is basically introduced by way of TDS, which has to be deducted by the e-commerce platforms. And most of the e-commerce platforms would be sourcing their goods through vendors. And obviously there are customers which are availing the benefit of purchase of those goods on the e-commerce platforms. But this withholding tax is applicable on the payments which are being made by the e-commerce platforms to the vendors. So there's a withholding tax of 1% at the time of payment or credit, whichever is earlier. A higher rate of 5% is applicable where the vendor is not able to furnish any PAN. E-commerce participant is defined to cover any resident selling goods or providing services through digital or e-commerce facility. And there is a exemption which has been provided for individuals or HUF, which is specified in the slide. What is clarificatory is that if this withholding tax of 1% or 5% as the case may be is deducted, then the same payment will not be liable for withholding tax under any of the other provisions of the TDS provisions applicable in income tax. Moving further, we now have a quick look on the incentives which have been incorporated for the financial services sector, where the benefit, and this is again a welcome change, where the benefit of 5% lower withholding tax on various interest for borrowings which have been taken by Indian corporates on external commercial borrowings or FPI investment in bonds. There was a sunset date of 2021, which has now been extended to 2023. A small amendment is that this coverage is now even extended to FPI investment in municipal debt securities, and again a further benefit of a 4% lower withholding tax in respect of bonds which are exclusively listed on IFSC. Moving forward, let's look at the incentives that have been introduced for startups, and again there are a lot of popular expectations riding on significant changes and significant amendments for startups, given the fact that government recognizes India is one of the leading startup ecosystems of the world. So two sets of amendments which we will quickly deal with. The first is that there is a existing tax holiday regime and some positive changes that have been introduced. So the time limit for claiming deduction for startups which are eligible as per the criteria which is already provided in the law, that has been earlier the maximum time limit was 7 years, and therefore now this has been extended to 10 years. The turnover limit for those startups which was 25 crores, and again a lot of people believe that this 25 crores is too small a turnover limit, so that limit has now been increased to 100 crores. So again welcome changes for the startups. One of the other changes which is introduced for startups is most of the startups, one of the popular tools to attract talent is by offering what is popularly called as employee stock option plans. And the current tax regime for ESOPs basically involves, so whenever the employees they exercise their options, which is one of the most popular forms of ESOPs that is prevalent, the tax is payable at the time when the employees exercise and therefore become shareholders. So therefore this is treated as a perquisite, and there was a very significant angst as a result of which many of the employees were not in a position to exercise their options, because at the time when they exercise the options, if there is no liquidity available on the shares, then this was considered to be a negative which did not incentivize employees to exercise their options. So the government has introduced a favorable tax regime whereby the perquisite tax which was earlier payable on exercise of stock options, at least as far as employees of eligible startups are concerned, they have a longer window, and the longer window is that the perquisite tax will not be levied at the time when the options are exercised, but it will be levied after the expiry of 48 months from the end of the relevant assessment year in which the exercise of option takes place, or the date of sale of shares, or the date from which the employee ceases to be an employee of such startup, and these dates will be considered on whichever is earlier basis. There is also a corresponding provision, and this possibly is introduced to deal with a situation where on account of leaving, if the employee is liable to pay the perquisite tax, but the employer is not in a position to deduct the withholding tax, then the liability has been cast on the employee so that he has to pay the tax which is deferred. So we have a time running out, and therefore we will deal with some of the other changes, and I'll be quicker. The Make in India rate, which was introduced by virtue of the tax ordinance, that has been extended for companies which are engaged in the generation of electricity. I might just want to point out that the benefit is available only to companies which are engaged in the business of electricity and not power, and such entities will be entitled to claim benefit of, so all entities which are opting for the Make in India regime will be entitled to take the benefit of ATM, which is the intercorporate dividends, provided those dividends are further paid by the corporate. For real estate, there is a existing 5% safe harbor. So if the transacted value is within the range of 5% from the stamp duty, ready reckoner rate or the circle rate, that 5% limit has now been extended to 10%. Another change is the tax incentives which are there for affordable housing projects. Again, the time limit has been extended from 1 year. Government has introduced the faceless proceedings, and therefore now we see in the budget proposal that faceless assessments, in addition to faceless assessments, even faceless appeals, so there are provisions for faceless appeals, and one will have to wait for the fine print in terms of how the faceless appeals will become applicable. The next change is the option to avail the dispute resolution proceedings is extended to all non-residents, and as regards the stay of demand by the tribunal, the ITAT may grant stay of demand up to 180 days only if the taxpayer deposits 20% of the tax or it provides security of equal amount, and extension of stay is not possible beyond 365 days.
Wouldn't be surprised if there is a constitutional challenge here, Umesh bhai. Anyway, that's for another day.
Yeah, since we are running out of time.
Sure.
One of the other important provisions that has been announced by the finance minister, and there is no mention of this, possibly because this will be introduced through a separate notification, is the Vivad Se Vishwas dispute resolution scheme. All of us are aware that with regard to indirect tax, the government has introduced a similar scheme which has been quite popular, and the FM has announced the scheme, which we will await all the details. But broadly, what this scheme entails is that if you have any tax appeals at whatever stage, whether it is Commissioner appeals, ITAT, High Court or Supreme Court, there are two windows that have been created. If you opt for the scheme before 31st of March 2020, then you have to only pay the tax, no interest or no penalty payable, and obviously if no penalty is payable, no prosecution will also entail. For those assessees who cannot take the decision to opt for the scheme before 31st of March 2020, then they have a further window of 3 months, which is 30th June, where the whole of the tax will be payable, but additionally some interest, and again this amount has not been specified. We would also, I think it has been mentioned earlier by my other colleagues, that the taxpayers charter is a welcome announcement, and CBDT has been mandated to come out with the taxpayer charter, and once the CBDT comes out with the taxpayer charter, basically it will deal with various time limits within which the citizens can expect that appeal effects, all applications to be dealt with by the tax officers within a particular time window specified in the charter. Those will be dealt with by the taxpayer, and I think this will significantly make things easier for both tax professionals as also the tax assessees. An important provision which I will very quickly deal is with regard to penalty which is applicable for fake entries or fake invoices. And all of us would have seen that under the GST regime, there is every few days we hear a lot of circular trading where invoices were being provided without actual delivery of goods or services. Now, in all such cases, government has introduced a penalty provision where the penalty is pretty steep. The entire amount of such fake entries would be liable for penalty. Again, if we read the fine print, and today we don't have the time, but this could create some more difficulties even in situations other than what is called as circular trading cases. As far as charitable trust is concerned, we will skip that. Some other changes which are welcome, that the limit of tax audits has been extended from 1 crore to 5 crore, and therefore and this is applicable only to businesses. So businesses having a turnover of up to 5 crores will not be required to obtain tax audit reports. Another major change is that the time limit for obtaining various the tax audit reports or other certificates, including the MAT certificate, transfer pricing report, any deduction under tax holiday, whether Chapter 6A, the time limit has been reduced by 1 month, except in the case of non-corporate SSCs who are not liable for transfer pricing. For them, 30th September is the time within which the certificates have to be obtained, and 31st October is the date within which they will have to file their returns. This possibly is in line with the government's avowed objective of introducing what they refer to as pre-filing of the income for all recipients in India. One of the other procedural changes, and I will just take a couple of minutes now, which is with regard to tax collection at source in respect of all remittances made under liberalized remittance scheme, where a 5% TCS has been introduced, and this also includes various tour operators. Now, since this is a TCS, that the companies which are providing the foreign exchange or making the remittance, they will collect the 5% TCS, and this will be creditable against the income, and possibly government wants to collate all information about all such payments which are being made.
And currently the yearly limit is $250,000 that you can make freely.
Yeah.
So I think there is a concern. There was an Indian Express scoop a few months ago which said that $45 billion had been moved out through the LRS route in the last 5 years versus $5 billion in the 5 years before that. So that Indian Express report has been well noted by the government. Can we hand over to Ranjit quickly, Umesh, in the interest of time, and then we'll come to questions and Akhilesh sir for his final comments.
Yeah, thank you all.
Ranjit, requesting you to hit a 2020.
Yeah, so good evening. I see the spotlight is clearly on the direct tax proposals, and that's very clearly because of the GST being a matter of the GST Council to sort of bring in. But there have been some amendments or changes that have been brought in respect of the customs provisions and in respect of the free trade agreements. So what we should be looking at and focusing on is the free trade agreements first, because that's where there has been a significant amount of amendment that we are seeing. So in the backdrop of growing global trade and India negotiating agreements, maybe participating in those negotiations or even exiting them, we've got a set of provisions which have now been brought in. We'll look at a more onerous sort of position for the Indian importer, who will have to satisfy the officer here in India at the border to ensure that he gets the preferential rate as per the agreement that is there between India and the relevant nation. So to check on misuse of the FTA or to control and filter the ineligible cases, there's a whole host of procedural and I would say administrative points which have been brought in to bring a sort of control on such transactions. So we've got the authority in India being able to sort of inquire, to check whether the eligibility exists, to look at the certificate of origin and question it and ask and place a lot of onus on the importer to substantiate his claim. It also goes as far as to say that merely supplying the certificate of origin will not absolve the importer from the benefit being available simply by providing that certificate. In other words, he will need to substantiate and give a lot of other information and answer the questions that the authority may pose. Now, this becomes very, very interesting because the powers that are now being given into the hands of the officer at the border will really be immense, where the ability to suspend exists, suspend the benefit of the trade agreement, where the position can also be that the importation will not be allowed with the benefit of the preferential rate, and rather bonds and bank guarantees may have to be given to make good the differential duty. And so a whole host of administrative difficulties may begin to be faced by importers who are looking at the free trade agreements. An interesting aspect of this will be that the agreements are between India and a relevant jurisdiction, and most often than not they would have a certain timeline as to how much in terms of time one can go back and discuss these agreements and have a retroactive check on those certificate of origins. But the provision and amendment that's been introduced now looks at a 5-year timeline, of course subject to the agreement between India and the relevant jurisdiction. In respect of the international trade, there was a lot of murmurs on a border adjustment tax being introduced, but and then that was to offset the disadvantages that the domestic or the local goods have, but that has been a no-show, and so we are only looking at amendments in the free trade agreements. The sort of other set of amendments that have been brought in are more to do with the customs levies. So we've got tinkering of rates largely going up to promote the Make in India sort of thrust of India, of the Indian government. We've got exemptions being trimmed and revisited, with many of them going away. The social welfare surcharge, which is at 10% of the basic customs duty, is also being harmonized, with it going away for several products and being introduced in very limited situations. And lastly, we are looking at safeguard duty being given more teeth. As we are sitting in a phase and zone where more and more international trade occurs, the domestic industry should not have to suffer any serious injury. And to sort of overcome that problem, the safeguard duty provisions are being given a little more teeth. So we'll have not just a duty levy, but we'll also potentially now have the ability to impose a tariff rate quota and other sort of similar measures to ensure that the domestic industry is not subject to serious injury. These would be the sort of key and headline points in respect of what happens in the customs and the international trade. What we've got in GST are actually just little tiny amendments, I would say more, just by the way, where we've got fraudulent cases being looked at with and visited with a 100% penalty. We've got a set of provisions which now have been amended to allow, or rather to provide, that there is a retrospective timeline within which the transition credit forms were supposed to have been filed. So there's a host of writ petitions pending across the country where there was no timeline prescribed in the statutory provision, and the arguments which were being taken were that the statutory provisions did not state and set out a timeline, and so therefore the rule which did so was the ultra vires. However, that may now come undone with this particular provision. We'll have to see what happens to those petitions which are pending, and in fact in the Bombay High Court this Friday there was a set of hearings which just concluded.
Yeah, Ranjit and Umesh, I think the 100% penalty provision is there in both GST as well as the Income Tax Act for fake invoices. Absolutely. So it's there at both places now.
So this comes as a very, very strong deterrent for people engaging in circular or circular.
And that's been one of the menace in the GST regime, fake invoices, fake ITs.
So I would just make one slightly additional point here, that the penalty in this case is also on the person at whose instance this particular set of transactions occurs. So this amendment in particular deals with the person at whose instance such transaction takes place.
Similar provision is also there in the direct tax penalty, where the penalty is either payable by the person who resorts to the fake invoices or person at whose instance the fake invoices or fake entries are introduced in books of accounts.
Yeah, Ranjit, couple of minutes.
So I don't think we need those couple of minutes. The GST ones are insignificant to pick up right now.
Wonderful. So Umesh bhai, you would like to take some questions. I think there are some more than a dozen questions, some of them quite complex. I know all of them cannot be taken here, but Rishi, Umesh bhai, you want to take? Umesh bhai, please.
Yeah, so the first question is, and I'm not dealing with the questions in any particular order. The first question is with regard to the relaxation where withholding tax has been deducted on FTS or royalty, and the question is whether this benefit also applies to withholding tax which has been deducted in accordance with the double tax avoidance agreements. Our first cut reading suggests that the benefit is only for withholding tax which is deducted in accordance with the Domestic Tax Act, and therefore it will be a 115A. One will have to see whether the benefit can extend to withholding tax that has been deducted in accordance with DTAA, especially in situations where either there is no withholding tax on account of make available, or the tax rate under the DTAA is lower than the rate prescribed under 115A.
One interesting question that has come in is that if a company has deputed someone to a subsidiary in Dubai, and that person is there is no tax liability there, and he is deputed, would that person be considered a stateless person under this provision?
The way I see it, Arun, is that the word stateless is really, in a sense, a statement of intent. If you look at the provisions of law, all that it says is that if a person is not liable to tax in any country on account of residence, domicile, or criteria of a similar nature, then that person would be liable to or be considered to be a resident. I did hear Mr. Akhilesh Ranjan early on to say that it is the intention of the DTC task force which recommended this to cover even cases like people in Dubai. But that said, I remember good old days when I argued the case of Mr. Rafiq before Authority for Advance Ruling, where it was held that liable to tax is broad enough to include liable to tax if such a tax is imposed. So if a tax in Dubai was imposed, which would be on the basis of residence, if you are more than 182 days there, then would you be liable or not liable? It's going to be a matter of debate, a matter of litigation. As I'm saying that, I was hearing the Revenue Secretary, and again the Revenue Secretary made this categorical remark that this is intended only for people who are not resident of any country. So as between the task force recommendation, government's implementation, and the interpretation, there could be a variety of views which will be coming up, all of which are not necessarily very pleasant.
Yeah, but Dinesh, I must say, out of the almost 24 questions, 5 to 6 are on this one. In fact, I won't go to, you want to cherry pick some of them, Umesh bhai, because we won't be able to cover all of them. I'll just read it out. Would a person having tax-free income because of zero tax in respective country, that would be taxable in India, suppose that respective country has nominal tax, say 5%, then it would be applicable. Will employee of eligible startup who gets ESOP of foreign holding company be able to defer his taxation?
So just on again, one can have a variety of questions, Arun, on the provision of Section 6, amendment to Section 6. I would simply say that whether you are deputed or otherwise does not change anything. Whether you are earning income in 10 countries does not change. I can foresee two things happening. One is that will people then want to surrender Indian citizenship, and would there be a demand for passports like Cyprus and whatever Turks and Caicos Island, etc., etc. Not an easy decision, but I can quite see people wanting to think in that direction, because if the law, because I think the law would be very unfair that if a person is a resident of UAE, Bahrain, wherever else for 25 years, and you say that his worldwide income is liable to tax in India on account of citizenship, I think the law is probably being a bit unfair. And if that is so, people might want to consider such drastic situation. Second is, what would happen? Would such people, if they are doing business, they are not salaried, for example, want to do everything in the name of a company? Now that company is not being managed in India, and the income arises to a company. What would happen in such a situation? So I can quite see, we are still sort of reading the provisions, grasping, but I'm sure people will not be wanting to be foolish enough to fall into a tax net and want to sort of get into a litigation.
Yeah, and just for some bragging rights here, we normally do not boast. Taxsutra put this out exactly a fortnight ago as one of the key recommendations of the DTC task force. Can we take a couple more questions? We have the time, and then we'll go for closing remarks from Dinesh Bhai and Akhilesh sir. Yeah.
One of the questions which has been put up is whether an eligible startup, an employee from an eligible startup receives ESOP from a foreign holding company. My sense is that eligible startup would only cover Indian companies, and therefore a foreign holdco which is provided options to employees. I don't think so that will be covered under the relaxation which has been introduced.
Yeah, one second. One of them is on the Mauritius route, which we've already said. Can we just still take it? Does the amendment to Section 90A impact the Mauritius routed transaction on grounds of treaty shopping, given India-Mauritius tax treaty is not a covered tax treaty under the MLI? Dinesh, for you.
The way I see 90A is making MLI a part of domestic law itself, and therefore whether it does not say that it is only applicable to those countries which have signed MLI. It really puts the MLI provisions in the domestic law, and if that is so, then one would need to demonstrate non-treaty shopping even in the context of Mauritius.
Akhilesh, sir, you want to just add something there, sir?
No, I think that's absolutely right. I think in any case, whether a treaty is a covered agreement under the MLI for some country or not, these provisions will at some point of time come into the relevant tax treaty, either bilaterally or through the MLI. So I think it's just a clarification sort of thing that this has to be considered. This will always be questioned.
And I would agree with what Mr. Akhilesh Ranjan is saying, as the provision being not only just rightly interpreted, but also something which is needed.
Yeah. There is a question on whether the PPF scheme continues or not. Is there any clarity there?
The PPF scheme will of course continue, but an individual has a choice to go for the regular regime or the new optional regime, in which case he will not be entitled to claim any exemption. So though he can make an investment in the PPF account, but he will not be entitled to avail the ATC deduction on account of the investment in PPF.
Yeah, and one question is on dividend. Would this create a non-taxation of dividend if, say, the shareholder is from Singapore, inbound investment in India, as Singapore levies tax on money brought to Singapore, if money is parked in other countries, say UK bank accounts? I don't know whether the question is clear, but...
No, but when the dividend is declared by an Indian company and received by Singapore, the recipient would be liable to tax in India. Whether Singapore levies the tax or not, I do not know. How is that relevant? So let's say that we have an Indian wholly owned subsidiary of a Singapore holdco. When the Indian subsidiary declares the dividend, the recipient is liable to tax. Assuming that Section 90A has no applicability, India-Singapore treaty will come into play. 10% is the rate of tax under the India-Singapore treaty, and that is the tax which will be suffered here.
Last question. Your pick, Umesh bhai. Last question. Can we just scroll down? Yeah, just one second. Did I miss it, or the FM did not say anything about pre-filled returns, or the TCS and TDS increase? Can we just scroll up a bit? Increase in scope indicate move towards this regime. Also, how are the amendments related to tax audit report filing 1 month before the due date going to help for pre-filled returns? This seems to be a little bit around pre-filled returns, which is one of the big recommendations or the big thrust of the DTC task force led by Akhilesh.
Yes, actually FM did discuss and did make reference to pre-filled regime, and possibly the amendments which have shortened the time period for completion of the tax audit report and various other certificates is a hint in that direction, and therefore many of the individuals could expect the tax officers to give a downloadable return which will indicate all the incomes that the relevant SSC would have earned and be liable, and therefore at least the SSC knows the information which is already with the tax department, and therefore he will need to be more watchful when he files the return. Again, seems like a positive amendment, but a lot of the devil will be in the fine print and how this whole scheme is actually implemented.
The only comment that I would put is that the fact that you are giving a pre-filled return is a service to a taxpayer and is very, very welcome. The question I have is that we have seen instances where the information which is available is not complete. A very practical example, one of the past presidents of the institute filed a tax return and the credit claim for TDS did not match with 26As, and he got a letter from the tax office saying your return is invalid. Now, absolutely, of course, contrary to the provisions of law, but we have seen things going down that path. And my question really is that let's assume that there is information which is in the pre-filled return and your information or your facts are different and you change it. Does that make you immediately vulnerable to a scrutiny? What does that mean?
Akhilesh, sir?
No, well, I know these are hypothetical situations, but the objective, of course, is to move towards a regime where more and more or greater portions of the return are pre-filled, especially for individuals. And in that process, of course, it does involve some amount of additional compliance for non-taxpayer, and all these documentation of the tax collected at source. These things are what the Indian tax system will also have to take into account. But I'm sure the idea is to not just when prescribing these returns, the tax system will also make sure that the information is verified in a manner that there should not be too many errors out there. There can be some cases where the taxpayer would have the choice to alter that figure which is there in the pre-filled return. I think those situations, if the alteration is substantial, might result in a scrutiny of the return. That's possible, but that will depend on the extent to which the change is made.
Yeah, Akhilesh, I'll take this opportunity. Can't let you go without asking a couple of questions. But before that, on pre-filled return itself, a quick word on whether this is intended to catch the evaders and to essentially sound an alarm that we have more information than you think about the taxpayer. Is that the intent?
It has not one. It has several objectives. The first objective is, in fact, taxpayer service, where you try to make return filing easier. That is a stated objective, and we're trying to do that to the greater possible extent for individuals, as I said. And the associated objective, which is, yes, I must admit, it is to keep track of these transactions. And these provisions, for example, on the liberalized remittance scheme, you had very rightly mentioned that government had noticed a huge amount of money leaving Indian shores through this scheme, and there is no other way really at the moment of monitoring as to why and who's sending to whom and for what purpose. The documentation is not proper. So these sort of mechanisms will provide the audit trail and make it more transparent and probably streamline the process.
Last question, sir. y'all worked, y'all really burnt the midnight oil. Y'all came out with a seminal report on the new direct tax code. There was a lot of buzz around it when you submitted the report a few months ago. Now you're seeing quite a few provisions coming in via the Income Tax Act amendment. Is the intent therefore very clear, sir, that yes, DTC provisions will be brought in, but via the Income Tax Act 1961, and we will not go for a new code? Does that seem to be the message, sir?
Well, I think I would say that the intent, and the FM did clearly say that he is moving towards a simplification of the law. Now, what has been done here, of course, there can be a debate of whether it's simplification or not, but a simplification of the law should entail many things which the new draft bill that we have submitted takes care of. So I think it is there on the government's agenda. Maybe this was not the right time to bring it in. Maybe that it requires further exercise on the part of the government. I think I'm not losing hope there. I think the new draft law, as written by the task force, will be considered at a point of time.
On that note, thanks so much, Akhilesh, sir, for joining us on this special budget webinar of International Tax Review, Taxsutra and Advisors. Umesh bhai, you want to thank everyone on our behalf. Thank all our readers. We really could not accommodate. We reached the absolute. Thank you so much for this astounding response. A short notice. Umesh bhai, final word.
Yeah, I think Saturday and.
Okay, thank you very much, everyone.
Thank you all for participating on this webinar, and thanks to Akhilesh and to Taxsutra.
And ITR. Anjana, to you.
Yes, thank you very much, everyone. That was really interesting. So firstly, thank you to everyone who has listened in, and thank you to all the speakers, especially Arun from Taxsutra, everyone at Dhruva, and especially Mr. Akhilesh Ranjan. You made this a very colourful and very interesting presentation. For those of you who weren't listening from the beginning, you can listen again. And for the questions that went unanswered, we will try our best to try and get as many of those answered for you after the webinar in the coming days. Thank you very much. I hope you enjoyed it, and thank you all for attending. Goodbye.